Today we're going to break down one of the most effective setups in smart money concepts, the Power of Three, also known as AMD. In this session, we'll go through what the Power of Three is, how to correctly identify it on your charts, the rules for high probability execution, and practical examples from real market conditions. By the end of this video, you'll know exactly how to use this setup in your trading. If you find value in this, make sure to support the channel, and if you're new, subscribe so you don't miss future content. Let's begin. What is the Power of Three? The Power of Three describes price movement in three clear stages: accumulation, manipulation, and distribution. Accumulation is the phase where price consolidates. The market moves sideways, creating equal highs and equal lows. Liquidity builds on both sides of this range as retail traders place stops just above and below. Next comes manipulation. This is when price breaks out of the range, sweeps the liquidity, and quickly reverses back inside. Many traders call this a fake out. The purpose of this move is to trap breakout traders and to trigger stop-loss orders, creating liquidity for institutions to position themselves. Finally, distribution. This is where the actual move happens. After the liquidity sweep, price displaces strongly in the intended direction and begins trending. This is the phase we want to trade. Accumulation in detail. During accumulation, markets appear balanced and undecisive, but in reality, orders are being built. Equal highs or equal lows signal liquidity resting above or below. On lower time frames, this often looks like a box or sideways market. On higher time frames, accumulation can last for days or even weeks. The key takeaway: never enter during accumulation. Wait for manipulation to confirm where institutions are targeting liquidity. Manipulation explained. Manipulation is where most retail traders lose money. They see the breakout, enter late, and get trapped. For example, if price breaks below a range low, retail traders expect continuation. They sell the breakout. But when price snaps back inside the range, those sellers are stuck. Their stops become buy orders, fueling the move in the opposite direction. Distribution and entry rules. The distribution phase begins once displacement confirms the real direction. Here's how to enter correctly. Identify the accumulation box. Wait for manipulation. Liquidity sweep above or below. Look for strong displacement in the opposite direction. Mark the fair value gap or order block created by that move. Wait for price to retrace into that zone. Place your entry. Stops go beyond the manipulation high or low. Targets should be liquidity pools or structural highs and lows in line with expansion. Bullish example, Power of Three. In a bullish setup, the market first goes into a consolidation phase. Price moves sideways, forming a range with equal highs and lows. This is the accumulation phase, where liquidity builds up above and below the boundaries. Then comes the manipulation phase. Price sharply breaks down below the range, taking out liquidity beneath the lows. Retail traders often think this is the start of a downtrend and enter short positions. But in reality, this move is engineered to collect liquidity. Once the sweep is complete, price quickly re-enters the range. That confirms the breakout was false. From there, the distribution phase begins, where price expands strongly upward. This is where we look for bullish entries, once the candle closes back inside the range. Stop losses are placed beneath the manipulation low, and targets are set at liquidity pools above the highs or at higher supply levels. Bearish example, Power of Three. In a bearish setup, the market also starts with a consolidation. Equal highs and equal lows build liquidity in a sideways range. Then comes the manipulation phase. Price breaks above the range, sweeping the liquidity, resting above equal highs. Retail traders think this is a breakout and jump into long trades. But again, smart money uses this to collect orders. When price quickly closes back inside the range, it signals the breakout was engineered. The distribution phase then unfolds to the downside. This is where we look for short entries after confirmation candles close back inside the consolidation. Stops are placed above the manipulation high and targets are set toward liquidity below the lows or into key demand levels. Chart example, Power of Three in action. Imagine watching the market on a lower time frame, such as the 15-minute chart. Price spends time moving sideways, building a clear box of consolidation. Suddenly, price breaks below the box. Traders who believe in the breakout enter shorts, expecting further downside. But within a few candles, the market quickly snaps back and closes inside the same box. This confirms the breakout was a trap. The manipulation phase is complete. Right after this, the distribution phase begins. Price rallies aggressively and breaks out to the upside, leaving the short traders trapped and fueling the bullish move. This is where smart money entries are made, with risk defined below the manipulation and targets placed at higher liquidity zones. Intraday application. On intraday levels, AMD repeats almost daily. Asian session, market consolidates. London session, price sweeps Asian highs or lows, that's manipulation. New York session, price expands in the true direction, that's distribution. This cycle makes Power of Three one of the most reliable intraday setups for institutional traders. 15-minute example, gold. On the 15-minute chart, gold often demonstrates the power of three. In the accumulation phase, the market moves sideways, forming equal highs and lows as liquidity builds on both sides. The manipulation phase follows when price briefly breaks below the range, attracting breakout sellers. Instead of continuing lower, the market quickly rejects and closes back inside the consolidation. Finally, the distribution phase unfolds as gold surges in the opposite direction, breaking above the range and expanding with strong momentum. 30-minute example, EUR/USD. On the 30-minute chart, EUR on USD provides another clear example. The accumulation phase starts with price consolidating for several hours, creating equal highs and lows. During the manipulation phase, the London session often drives price above the highs, inducing breakout buyers. Price then quickly rejects and returns to the consolidation. The distribution phase follows as euro per USD reverses direction and expands lower, continuing with momentum into the New York session. Mistakes traders make. Let's cover the common errors. Entering inside accumulation before manipulation confirms. Trading the breakout of manipulation as if it's real. Ignoring displacement confirmation. Trading against higher timeframe bias. Avoid these and the power of three becomes much clearer. Important note on psychology. Understanding the psychology is key. Retail traders chase breakouts. Institutions create false moves to trap them. Every manipulation move is designed to take liquidity. Your job is to wait for it, not fight against it. Higher timeframe alignment. Power of Three works best when aligned with higher timeframe structure. For example, if the weekly chart is bullish, focus on bullish AMD setups on the lower timeframes. This alignment increases probability and provides cleaner targets. Conclusion. To recap, accumulation builds liquidity. Manipulation clears that liquidity. Distribution delivers the true move. The power of three is not just a pattern, it's a model of how institutions move markets. By applying it correctly, you trade with order flow instead of against it. If you found value in this lesson, make sure to like the video, share it with other traders, and subscribe for more professional trading content. Thanks for watching, and I'll see you in the next video.